But as promised, let's turn our attention to the banking and the financial space now and invite Sumeet Kariwala, the ED Financial Equity Research, who's joining us from the sidelines of the Morgan Stanley 21st Annual Asia Pacific Summit. Sumeet, morning, and this is Rima here. Thank you very much for joining in. Now, banks have seen a re-rating across the board, but you believe we could see a second leg of re-rating. Can you take us through your thesis?
Yeah, hi Rima. Thanks for having me on the show. So, yeah, you got it right. What we've been calling for in banks is the second leg of re-rating cycle. Typically, what we have seen is that when banks come out of recession or slowdown, they re-rate in two legs. The first leg is driven by asset quality turnaround, which has played quite a bit. There are still some banks which need to re-rate, but a lot of that is done. The next leg of re-rating will be about revenue growth, and banks can deliver that, will take part and re-rate further. Revenue growth will be a function of two things. One is loan growth acceleration, which we've already seen, and I think so there are more legs to come. Even on margins, we've been quite surprised so far, and I think so a significant part of the margin expansion that we have seen is something that banks will be able to retain over the next 2 years.
Okay. Good morning, Sumeet, and thanks for joining in. You know, in your report, you write that you're scanning for stocks that are not fully pricing in a growth upcycle, and just wanted to mention some of your top ideas. There's ICICI Bank, Axis, Bank of Baroda and SBI. But don't you think it's a bit of a crowded trade now? I mean, SBI has gained over 30% this year already. Have investors missed the bus on these names, or do you think that this is just a start of a structural upcycle?
Yeah, hi. I would say this is start of a structural upcycle. If you look at stock performances of the last 1 year, it might be misleading because some of these stocks have not done well for the past 5-10 years. I think so what's happening in India is that over the last 10 years, we've been just moving from one crisis to another. We had a corporate NPL cycle. This was followed by demonetization, GST, NBFC crisis, and then COVID-1, COVID-2. In our view, Indian banks, through these cycles, have provided aggressively, particularly in recent years. And if I look at the balance sheet, be it government, be it private sector, be it financial sector, the balance sheets are so good, and I've never seen such kind of balance sheets for years now. From here, until as we have a sharp economic global slowdown, I think so there'll be a very sustained pickup in loan growth. And that is something which is not going to be for one or 2 years. It should be like for, say, 3 to 5 years. The balance sheets are squeaky clean. So even a slightly slower global backdrop will mean that Indian banks can actually do very well.
All right, got that. Sumeet, thanks for joining us. This is Pavitra. So, you know, you are saying that the re-rating cycle, the second leg of the re-rating cycle will be aided in large part by the kind of loan growth that will come through, right? So, I want to ask you, what is the kind of loan growth that you're picturing, you know, for the entire industry, say in the next year? And what banks do you think are well positioned in that space to sort of really benefit from this?
Yeah, that's a good question. So if I look at loan growth over the last 6 months, it has accelerated from 9% to 18%, quite to our surprise. Now, if you look at the drivers to that, part of this is driven by base effect because same time last year we were going through the after effects of second COVID wave. What's going to happen going forward is that we're going to see a corporate capex cycle pick up. We're seeing the green shoots of that. There's always been demand, but the big benefit that we have now is that the supply side is in place. As I told you, banks' balance sheet, corporate balance sheets are very, very good. And that's going to mean that over the next 1-2 quarters, even if loan growth slows down from 18% to say 14-15%, we're going to see re-acceleration to 16-17%. If I look at the past 10-12 years, and if I had to select stocks in India, what I used to look at is balance sheet, asset quality, who's not sitting on corporate NPLs, who has the capital to grow. The next 3 years are going to be very different. If there's one metric which I want to see over the next 3 years, and the banks which will be able to capitalize on growth, therefore, that'll be deposit growth. I think so retail deposit competitive intensity will pick up quite meaningfully, and banks that can gain market share in retail deposits without paying up will actually be able to deliver much better revenue growth as well as re-rating.
Talking about trying to garner the deposits and being competitive, that would imply the deposit rates would start going up from here on, and we've already started seeing that. And generally, deposit rate increases lag the lending rates. So if we've now started to see deposit rates rising, will it not pressure the NIMs? Because I think at the onset you said that you expect the NIMs to sustain at these levels. So what makes you so confident that NIMs will hold and not decline as deposit rates increase?
Yeah, that's a very fair question. See, if I look at retail deposit rates, they've gone up over the last 6 to 9 months, but bulk of the increase actually happened a month back when SBI took up deposit rates by 60 to 80 basis points. I think so. Deposit rates will have to go up further. If I look at the spread of retail deposit rates to say repo, the spread has actually declined. So I would say deposit rates will go up further. What is going to happen is that the lead lag that we are seeing with respect to margin expansion is going to continue. Over the next 2 quarters, banks will gain on margins further. What's going to happen is the full impact of deposit rate hike will come in fiscal 24. And whatever we gain over the next 2 quarters is what we're going to give back over a 1.5 year period. So there'll be some lead lag, but structurally, whenever interest rates rise, banks benefit on margins because current account, savings account deposits, they don't reprice upwards. Interest rates are moving up because growth is looking better, and that also means that banks will cut down on risk aversion and grow the unsecured and higher margin segments faster. So the loan mix diversification also helps on margins. So I would say a lot of margin expansion that we've seen is something that banks will retain. There'll be lead lag, but 2 years down the line, the margins will be higher than what they were 2 quarters back.
Okay, what about valuations? I was going through your own valuation table, and for something like an SBI, it's still trading at a little over 1 time FY24 price to book. Of course, it is the most expensive in the PSU banking space for a reason. But do you see more valuation headroom now, especially for PSU banks?
So I would say let's think about valuations through a cycle. Okay, when banks are not doing well, when we are in a recession, slowdown, valuations will be below long-term averages. When the cycle is okay, we see valuations come closer to long-term averages. Valuations actually move higher than long-term averages when loan growth comes back, and that's the time when valuations do very well. My view is that for a lot of these banks, valuations are still below long-term averages or around long-term averages. So valuations, I would say, if loan growth is coming back, will actually surprise to the upside.
Right, that is on valuation. Sumeet, another question I want to ask you is on how do you look at the slightly smaller banks, the mid-sized banks? Are you as optimistic on growth for these banks as well? I mean, I know you like Federal, but take us through the kind of growth that you're penciling in for the smaller banks.
Yeah, so I would say that if I look at the last 10, 12 years, the smaller banks did very well. That was because the competitive intensity was rather benign because some of the large banks were going through corporate asset quality cycle and so on. This cycle will be good for the small banks, but it may not be as great as it was for the last 10 years because the competitive intensity both on retail deposits as well as retail assets will be significantly higher. There are small banks which can do well. Some of the banks which have very good underwriting capabilities, who can actually take more risk and deliver risk-adjusted credit costs. Some of these banks will do very well. I don't want to get into stocks, but yes, we'll have to be more stock selective rather than buy the basket.
And just one final word, Sumeet, as you speak to a lot of investors at your annual Asia Pacific Summit, what is the feedback when it comes to Indian banks? Are they as optimistic as you are? Are they willing to buy at these levels? Because we've already seen one leg of re-rating and a significant share price gain. Are they comfortable with the risk-reward at these levels?
I think so. As I talk to investors, I see more and more investors understanding that this is not a 1 year, 2 year story. This is more like a 3 to 5 year story. Yes, they know that valuations have done well, and they don't look at valuations only relative to India. They look at valuations as compared to what's happening globally, and in that context, valuations will not look that attractive. So I think there's a lot of interest, a lot of people who want to buy on this, and as they see more conviction around loan growth sustaining, you would see more flows into India for sure.
Okay, Sumeet, have a great conference. It's sounding a bit noisy out there, so I'm going to let you go back to it. But thanks for joining us and giving us an update. That's Morgan Stanley, very bullish on the banking space.